Are you surprised by the magnitude of the loss, considering we've been looking at U.S. futures pointing to another negative open?
No, I'm not surprised at all. The market's been rallying really in an unprecedented way. I mean, let's put this in perspective. The markets are back to where they were, 60 days ago? We still have huge gains in 2017, and it's been a long time since we've had any sort of bump down in the market, any sort of correction. Obviously, people are concerned about interest rates, but it's not a surprise to me. I've been expecting that there would be some sort of resistance to the market just continuing to go up.
When we consider the sheer huge run up in points to the downside, we're talking about lower by 1,600 at one point. Unprecedented numbers here, though. What role do you think computer algorithm trading was playing in this?
Probably a lot. I think they're really that sort of slope in terms of selling. I don't think really is driven by individual investors. It's driven by institutional investors, and it's driven by program trading. As Jim Cramer said on his program, he thought it was another flash crash. I don't know if it's a flash crash, but I know it is really very much computer driven. There's models out there that point that if certain news comes out, the sell signals go out, and it turns into sell orders. So I think that was a big part of what happened today.
And Clive, I want to bring you in here because, yes, when you talk about this perspective, Michael points out, it's crucial to consider where we came from. For days now, we've been talking about record after record. When would we get a bit of a correction here? But are you surprised by the magnitude?
I think that, similar to Michael, I'm not surprised that the correction has taken place. However, that's not to say we forecast the timing. The timing has been the big uncertain factor. And really since late last year, we've been, if you look at the averages, on average, you see about a 10% or a 10% correction taking place, at least around about every 350 odd days. So we were overdue, that was clear. But I think what's interesting now is while the futures are pointing to a softer opening, is the action in the bond market and the dollar trend? Because I would argue that's more supportive.
Yeah, let's bring in Michael back on that one, because Michael, interesting to watch the 10-year Treasury yield in particular. I think it was the biggest one-day drop for the yield in some 5 months here. Very different story than the picture we were looking at just last Friday. What does this suggest to you when it comes to the implications for equities?
Well, I think the 10-year Treasury is really saying what? That first of all, it's flight to safety. People buy the 10-year Treasury. But I also think, as Chairman Powell just said in his first speech as Federal Reserve Governor or Federal Reserve Chairman, that we really do have fairly low inflation right now, that there is a reasonably solid financial system in terms of solvency of financial institutions, and that there isn't really a huge warning sign for inflation. There's a fear for inflation, but not a huge warning sign. So I think the fact that the 10-year Treasury, I think it went as high as 2.8 today, on the yield went back down to 2.6. I think that suggests that maybe some of this inflation fear is a little bit overblown at this point. Inflation is just not there yet. What's there right now is fear of inflation, and that's what's driving market volatility today.
But when we got the start of this sell-off, even at the end of last week, people were saying it was precisely down to inflation. It was down to fears of the higher rate environment. So if this isn't the case, what is the catalyst as you see it?
No. I want to make a very clear distinction here. There's a difference between the fear of inflation and there actually being inflation. And right now, there is not the type of inflation that people fear. Now, the market's anticipatory in nature, right? So in the end, if there is a fear, it's going to price that into the future pricing for equity assets. At this point, I think that it certainly is more of a wait-and-see attitude. I mean, obviously, the jobs numbers came back stronger than expected, and that really, I think, is what's triggered this market sell-off, which was triggered by the fear of rising rates because of the strong job market. So I think it's important to understand the difference between fear and reality.